Hello, I'm Mark Fleming, the Chief Economist at CoreLogic, and welcome to our Summer 2014 Housing Update. So one of the concerns in the housing market today is that housing has become less affordable than it was relative to a year ago. And we asked the longer run question, is it affordable today relative to the longer run average? And most people would say, yes, it is still highly more affordable. But we're going to delve into really understanding what it means to be affordable. And of course, there's this risk issue of, is it a bubble? House price appreciation has been quite impressive over the last year to year and a half. And so the concern with the high levels of growth rates is that house prices are now outpacing incomes and again causing a bubble to occur. In this first slide, you can see the home price appreciation rate year over year. You can see the big decline in house prices through the mid-aughts and the recovery that we've seen since then. Impressive growth rates, 18 to 20% in some markets, or even more in places like Las Vegas and in Nevada and in parts of Florida. We do expect that year-over-year growth rate will moderate back to a 5 to 6% level over the next year to year and a half, and that's much closer to historic normal average long-run growth rates. So one of the reasons why we talk about are things in a bubble is if you have 15 to 20% growth and no income growth, are things becoming less affordable? Well, if we simply look at the duration of this cycle, we're basically right on par. Clearly, the depth of the house price declines was much greater than in regional recessions shown on this chart. But in terms of the duration and timing, we basically bottomed out at about the same time as the regional recessions nationally and in Nevada and California, also shown here. But we bottomed out at much lower cumulative decline amounts, around 35% nationally. But the pace of recovery is about the same. The problem is that since we're so far below, it's just taking longer to recover back to that higher level. Now keep in mind this is indexed to the peak, and the reality is we probably should never have been at that peak point. So how do we better understand relative pricing? Because if we can't use the peak as a good basis, we're concerned about affordability relative to incomes, we want to look at measuring the relative relationship between what we call fundamental levels of house prices relative to actual levels. Our house price forecasting models allow us to do this because we basically estimate what we believe is a fundamental income-driven level of house prices in all the major metropolitan areas in the US. So we use that as a basis relative to actual house prices and measure the percentage gap. So if, for example, house prices in San Francisco are supposed to be on average $600,000, but the average price is, say, $800,000, that $200,000 gap is measured in percentage terms. By the same token, in Detroit, the average house price might only be, based upon income levels, $150,000, but a $200,000 actual price would also create a gap. So we measured those gaps over time, historically, in the 50 largest markets, and I made a population-weighted average here that shows the relative proportion of over or undervaluation of housing relative to that fundamental income-driven price level. And you can see in the early 2000s, we were ever so slightly undervalued. There's a clear run-up in prices. We were in a housing bubble. House prices basically exceeded fundamental prices by about 15% at their peak. You can see the large collapse causing a correction in the house price relationship to fundamentals, and also, most importantly, the big overshooting that occurred. In this chart, we basically overshot fundamental price levels and became undervalued by a little over around 10%. All of the house price appreciation that we've observed across these largest 50 major metropolitan areas in the last year to year and a half is actually getting us back up towards normal. And by our estimation today and our forecast for the next 2 years, we still see a slight to moderate undervaluation of house prices relative to fundamental prices. So when we ask the question today, is housing more or less affordable? It seems like it's actually slightly more affordable than it should be on a relative basis to fundamental incomes, and it's expected to remain that way for the next year to year and a half. And lastly, we want to look at it from a classic affordability perspective using the NAR's methodology for calculating median affordability. The blue line represents the 50th percentile, or the median affordability metric that we all are very familiar with that comes from the National Association of Realtors. And in that indication, we peaked at a very high level of affordability a couple of years ago, or about 2 years ago, but it has come down. So housing is less affordable than it was a year to a year and a half ago, but it still remains highly affordable relative to longer run historic averages of the early 2000s. But let's talk about the other elements of the income distribution. I, for one, don't know very many people that sit at the median level of income, and I have a hard time finding the median priced home. So we do the same analysis at the bottom at the 20th percentile and at the top at the 80th percentile of the income distribution, and compare the 80th and 20th percentiles incomes to the 80th and 20th percentiles of home values, and do the same calculations as is done at the median. You can see a very interesting outcome, and that is that housing is actually considered to be more affordable for that 20th percentile lower incomed individual than for the 80th percentile higher incomed individual. And that's largely because the low end of the housing stock, there are a lot of very, very inexpensive homes. Now the big question here obviously is, would these people be able to access credit? The fact of the matter is the 20th percentile income is only about $20,000. It's actually below the poverty line for a family of 4. So in all likelihood, while we can do this analysis, that line probably doesn't exist because they're unlikely to be homeowners in the first place. And the 80th percentile individual, while his level of affordability for the 80th percentile home is not so great relative to the median person, the fact of the matter is he can afford most everything below that in terms of his affordability. His level of income allows him to buy low-priced and medium-priced homes. So by this analysis, we don't get a good understanding of truly how many people can have access to affordable housing. That's a question we need to continue to ask ourselves as house prices rise and interest rates rise into the future. Once again, thanks for tuning in to CoreLogic's Housing Update. For more information, go to the Insights area of CoreLogic.com for our research blog and other housing statistics.